Hi Forex traders, welcome back. My name is Francis, Caris Trading Institute. If you are a new viewer on this channel, kindly click on the subscription button. Don't forget, hit the notification bell so you stay updated every time I post a video. In today's episode of the video, I want to show you an easy ICT trading concept that's going to give you 4 entries a week, and it's going to help you scale up your proprietary valuations as fast as possible. So without wasting much time, let's go to the chart as I show you how to do this. So guys, this is a very powerful trading concept I want to show you, and I want you to maximize this strategy. It's going to accelerate your profitability curve just using this concept in your trading, specifically day trading. This is for day trading, and the goal is to take out 40 pips every single day. 40 pips, that's the goal. Take out 40 pips every single day. You execute a trade using this strategy. Again, day trading is not everyday trading. You have to put this to consideration that we are doing day trading does not necessitate that you must execute a trade every single day, okay? But in the days that you find an entry, in the days that the setup meets up with your criteria, then you should be able to bag at least 40 to 50 pips on every single trade you take. So guys, what are the criteria for this strategy? Number one is you must know your directional bias from the higher time frames. Remember, because we are doing day trading, it's important we know directional bias from the daily time frame, because the higher time frames are the draw on liquidity. So we want to know what is the daily institutional order flow and market structure of the daily time frame. So daily institutional order flow and market structure of the daily time frame. Okay, we need to know what the daily institutional order flow is and the market structure of the daily time frame, because that's where the draw on liquidity is going to be residing. The institutions position themselves largely on the higher time frames, okay? But because we are considering a day trading opportunity, we will like to position ourselves within we would like to position ourselves alongside the institutions residing on the daily time frame, okay? But because we are considering day trading, we would like to preposition ourselves with the daily institutional order flow and market structure of the daily time frame. That means we need to see willingness of the daily candles to take out previous daily highs or previous daily lows in a bearish market structure, and then we need to study where price has traded from using price delivery algorithm concept. We need to know where price is trading off. Are we in an expansion or a retracement move? Are we in a consolidation or in a reversal move? You have to put this to consideration. In an expansion move, we need to see willingness of the daily candles take out previous daily highs in a bullish order flow. We need to see willingness of the daily candles to take out previous daily lows in a bearish order flow. And you understand what market structure is. We need to see price showing consistency in the formations of higher highs and higher lows on the daily time frame, okay? So when we know that we have a bullish market structure, then the next thing you are going to do is to just go down to your 15-minute time frame. This strategy is a 15-minute base strategy because it's a day trading strategy. So you just go down to your 15-minute time frame and look out for the Asian session, mark out the Asian session, and then I'm going to show you how you're going to use that to execute your own trade. So the first thing is identify your Asian session range. Okay, so the next is we identify the Asian session range or Asian range. Okay, the Asian range. That's what you're going to identify, the Asian range. And then an ideal Asian range, an ideal Asian range should be between 20 to 40 pips. We want to see this Asian range between 20 to 40 pips in days where our Asian session is above 40 pips. Then we don't want to execute a trade, or we will lower our expectations because the Asian session has already done 40% or 50% of the average daily range. The average daily range is mostly between 80 pips to 100 pips for most pairs. So once you see the Asian session range is above 40 pips, then you should lower your expectations when you finally find an entry. Okay, so second thing is identify Asian range, and it shouldn't be above 40 pips. It should be between 20 to 40 pips. Then the next thing you want to be doing is look to see price trade above the Asian range in a bearish order flow and below the Asian range in a bullish order flow. So for example, for a bullish bias, you should look out for, or look to see price trade below, look to see price trade below the Asian session low. Okay, the Asian session low, and then we buy below the low or at the low of the Asian session. So guys, for a bullish bias, we would like to see price trade below the Asian session low, and then we are looking to buy below the low of Asian session or at the low of the Asian session. This is for a bullish bias, and vice versa for a bearish bias. When you have a bearish order flow or bearish bias, we would like to see price trade above, in this case, trade above the Asian session high. Okay, above the Asian session high, and we will be selling above, we sell above the high of the Asian session, or we sell above the high, or at the high, either above the high or at the high of the Asian session. This is when we have a bearish bias. Okay, we would like to be selling above the Asian session high or at the Asian session high. That's where we want to be selling, and then we target 40 pips as our take profit, and we are done trading for that day. Okay guys, so let's go to the chart as I show you how to do these things. So guys, the first thing we'd like to do, I'm going to do a hindsight study from last month. Let's just go to the monthly time frame. Let me outline last month's previous price action. Okay, I don't want to use December because December is not a good month, although we will still go through December, so I show you that the concept actually works every time. Okay, so last month we had a bullish price action. It was a bullish order flow. On the weekly time frame, you would have seen that price has been showing willingness to take out previous weekly candles. Previously, price has been taking out the previous weekly candles, weekly highs, so telling us that this is a bullish order flow. Okay, so as at this time, we had a bullish market structure. We had a bullish order flow. Okay, because price had taken out this high, price from the lower low, lower high, lower, higher low this time around, and then price break structure. So we had a shifting market structure. This is a bullish shifting market structure, and then the weekly candles have been showing willingness to take out previous weekly highs. So guys, what we have is a bullish order flow as at that time. So we go to the daily time frame. So on the daily time frame, you could see that price broke structure. This is an expansion move. What's the next? Retracement into an internal range liquidity. In this case, the bullish order block was retraced into, and then we want to start seeing bullishness. So let's just say from this very point where we started seeing, where we outlined the entire order flow, just go down to your 15 minutes. Once you are able to know where the directional bias is, bullish or bearish, go to your 15 minutes time frame. Remember, this is just a day trading setup. You're more interested in knowing the institutional order flow of the daily time frame, and then just go down to 15 minutes and look for entries. Okay, so this is our daily time frame. As at this point, the current institutional order flow was bearish because we are seeing the daily candles taking out previous daily lows. Okay, the daily candles taking out previous daily lows, even though this is actually a retracement move. Why? Because this was an expansion, it broke structure. This is a retracement into internal range. You know how to outline these things, right? So we had a retracement sell here. So the current institutional order flow as at this time was bearish, even though this was a retracement move into internal range liquidity. I would have been looking for fair value gaps, other block, price traded into this, and then the bias returned. So guys, when you determine the institutional order flow of the higher time frame, that's the directional bias, then you identify liquidity pools that is going to be traded into in form of external range liquidity. And in this case, as we can see, we said price retraced into an internal range liquidity, which is the other block here. We will be expecting price to trade into the buy side liquidity residing above this equal high, the body of the candle, and this old high, because there is a pool of liquidity residing above these highs, right? Then the next thing you're going to be doing is to blend time and price. That is, you are looking for your trade setup during the London and New York session. The London session is usually between 2 to 5 a.m. New York time. I don't know what time zone you're using, or whatever it is. I would like you to convert this to your local time using there's an app I use on my phone. It's called Time Woody. I use it to convert New York time zones to my own local time. So the London session or the London kill zone is usually between 2 a.m. New York time to 5 a.m. New York time, and the New York kill zone is between 7 a.m. to 10 a.m. New York time. So when you convert that to your time, it's going to give you the ideal local time. So you are looking for your trade setup between these time zones, between London session and New York session. That's when I'll be buying below the Asian low or selling above the Asian high. Okay, so guys, let's go to the 15 minutes time frame and do a inside study of these things. Okay, let's just do a quick inside study from using the daily time frame. Remember, since it is day trading, we are looking to take trades using the daily time frame directional bias on a lower time frame. Okay, so let's just do sell bias and then let's do buy bias. Okay, I just want to show you so that you know that these things truly work. So you go to the 15 minutes time frame. Remember, now we are done with identifying directional bias. Now we are going to be looking for entry signatures using the Asian session. So what we should be doing now is to identify the Asian session. We sell above Asia, we buy below Asia. So to identify the Asian session, I'm going to show you an indicator on TradingView that is going to help you identify Asian session. Okay, and so what we'll do is just go to the indicator section of your TradingView platform. Look at this indicator, click on it, then search for Asian range and kill zones. That's the indicator I prefer to use in identifying Asian sessions on TradingView. So when you click on it, it's gonna add up on your chart. So guys, once you add up the indicator, I would like you to click on the indicator here. Bring your cursor to the indicator and click on settings. Then I would like you to tick on the display Asia range. Then the deviation should be kept at 2. You can change the color you want to suit the one you want. Then the Asian session should be kept at 17.00 and 1.15. okay, that's the ideal setting I want. This is for GMT. This is the ideal GMT settings. Then display London open and click on display New York open, because I want to know when the New York sessions are active. Okay, remember I said the last criteria is that we want to be executing our buy or sell trade during the London and New York kill zones. Okay, that's 2 to 5 a.m. time period. That's when I'll be looking to sell above the Asian session high or at the Asian session high, and that's when I'll be looking to buy below or at the Asian session low. Okay, the New York kill zone between 7 a.m. to 10 a.m. New York time. When I don't find a setup during the London session, I'll be looking to buy or sell during the New York session kill zones. Okay, and if there is no setup, I stay off the trade at all. Okay guys, so let's quickly look at what we have here. The blue boxes here are the Asian session. They define the Asian session, and remember I mentioned that an ideal Asian session shouldn't be above 40 pips. It can go above 40 pips, but if it is above 40 pips, we will need to lower our expectations for that day, because price may have traded half of the average daily range of that day. Okay, so we may need to lower our expectation, and the goal is to take out 40 pips on this trade. That's the goal. Once you take 40 pips from this trade, take profit and wait to do the same thing again and again on a different day. Okay, your goal is to take 40 to 50 pips and you're done trading for that day. So let's see what we have here. Remember, as at this time, price had shown us signatures to retrace into the internal range liquidity on that daily time frame. We had seen a breaking market structure on the 1 hour time frame, telling us that this is actually a retracement move into the internal range liquidity of the daily time frame. So the current institutional order flow here is bearish. Then we are going to identify our Asian session, and we have our Asian session already marked up by that indicator here. And we said the next thing is define the pips or the range. The range, is it more than 40 pips? Our range here is actually 32 pips, and it is ideal for a good trading day. Okay, it is ideal for a good trading day. Then what's the next thing we are going to be doing? Look to sell above the high of the Asian session or at the high of the Asian session. When you are selling at the high, usually it's during times when you have a breaking market structure during the Asian session. Usually price will not trade above the Asian session high during London or New York. Rather, price will trade into an institutional reference point during the London or New York kill zone. So you will be selling within that institutional reference point. Usually it's a return to order block or return to internal range liquidity, fair value gap order block, breaker or mitigation block. Okay, if you are still yet to learn about this institutional reference point I just mentioned, I would like you to go through the other videos on the channel, specifically the video I titled Order Block is Not Smart Money Concept. I taught about 7 institutional reference points in that video, and you're going to learn about each and every, and you're going to learn about these institutional reference points because they are really important to your trading. Okay guys, so we are looking for breaking market structure after price has traded above the high or at the high. And look at what happened. We had a breaking market structure during the Asian session. Price broke structure, price took a liquidity above this, price broke structure below. Okay, so I won't be expecting to see price trade above that Asian session high, except it's going to be a stop hunt or a manipulation, and this is actually a breaker block. So what we have here is a breaker block. I'll look for confluences of another block of fair value gap with that breaker. So what do you have here? You have a bearish order block at that breaker. I'll be selling once price returns into that order block. Okay guys, that's an internal range liquidity, right? My stop loss will be away above the other block or a little bit away, but ideally it should be above that other block, and I'm targeting how many pips? 40 to 50 pips. Now when determining where to take profit, you look for pool of liquidity on an external range. That's where you are looking to take off profits. And if you look at this, the next external range liquidity you have here is this external range here. So let's see if that's going to give us 40 pips. I'm very sure that should be more than 40 pips, but we are targeting just 40 to 50 pips, guys. That's how you scale up profit evaluations, finding something that works consistently on a daily basis or on a weekly basis. So when you execute your short here, let's take for example, we are selling from that outlined order block, the bearish order block here. That's where we want to be selling, and then we put our short here and our stop loss above that order block, okay, or a little bit away, just that order block or a little bit away. And then we expand to that external range liquidity. We may not wait for price to reach here because we're only trying to catch 40 to 50 pips. Let's see how many pips this is. This is about 80 pips. So you can see that this is twice your target. And if you learn the art of contentment in trading, if you can just catch 40 pips again and again, it's going to go a long way in your trading journey. So guys, this is one trade. Let's look at the next day. This is our Asian session. We still want to be selling above or at the Asian session high or low. Okay, so guys, this is the Asian session, and we see price break structure in London. Okay, price broke structure before London, actually not really in London. Price broke structure. I'll show you where or how to blend this time and price broke structure. Then we are looking to sell on a return to what? Mitigation block. Look for confluence. It has another block attached to it. Okay, we are looking to sell on return to this mitigation block. Our stop loss should be above this other block. Okay, so guys, when price returns, we sell. And where are we looking to take profits? Because this is actually the return, we are looking to take profits below this or before price gets to this external range liquidity. Okay guys, before price gets to this external range liquidity, or we can wait till it gets there. But you see, if you were waiting it for price to get there, you may not have gotten the, you may not have taken profit. So we are looking to enter once price returns to that mitigation block and it has an order block attached to it. So let's say this is our entry, and stop loss is above that mitigation block. Our take profit is, we said 40 to 50 pips. That's our goal, right? So let's see if we get 40 pips from this trade. Let's just randomly say this is, so you can see this is 49 pips. Okay, so these are days when you have let's measure the Asian session and see if it's actually 40 pips. So the Asian session is actually 40 pips. So these are days when you're going to have a low volatility day, even though price actually delivered 40 pips after the Asian session. And this is during New York session. This is New York session, guys. So you see, we do not have an entry during the London session. Okay, this is 7:45. We do not have an entry during the London session, but we got the entry during the New York session. So you have to learn to be patient and blend time and price together. This is the next day Asian session. Measure the Asian session range just to know what that is. This is 23 pips, which is ideal day, ideal for a good trading day. We are looking to sell above the Asian session high or at the Asian session high. When you are selling above the Asian session high, usually it's when price runs liquidity equal highs or equal lows when you are selling below. So usually it's in form of stop hunts to take out liquidity above equal highs and equal lows. Then you look for breaking market structure and sell. So, but in this case, we see price break structure immediately the Asian session closed. Price broke structure, and before London, price broke structure, and during London session, this is 7:45, it's London session. Remember, we said 2 to 5 a.m. New York time. When you convert that to GMT, it's usually between it depends on the daylight savings, but it's usually between 7 to 10 a.m. okay, and 8 to 11 a.m. GMT plus 1. So guys, we're looking to enter at what? A return into what? Institutional reference point. Look at this. This is a breaker block. Price took out liquidity above that high and price break structure. Remember how I taught breaker blocks, right? I said a breaker block is when you have liquidity taking on two sides. Give me a minute. Well, liquidity is taken on two sides. Number one is price from the higher high, and then price break structure. Then this is your breaker block, right? This is that breaker block. The other block that was violated, that's the breaker block. Okay, and I see that we have something similar. Okay guys, we have something similar. Okay, price from the higher high, price break structure to the other side. So we are looking to enter once price returns to the last order block that's violated. Look for confluences of other block of fair value gap attached to this breaker. In this case, we have a fair value gap attached to it. Then you outline that fair value. Okay, and then look to sell when once price returns to the low of this fair value. That's where I'll be looking to sell. My stop loss is above the other block, guys. And then once you do this, let's see, you sell immediately, price returns, and this is during London. Price returned into that institutional reference point, and we are looking to go short. Price went down, stop loss is above the high of that other block. Yeah, so this is 1:3. Let's see, our goal is to take 40 pips and we are out of the trade. So this is 44 pips. 44 pips. I think this is 1:5. We are out of the trade. We are out of the trade, guys. You're done trading on this trading day. Okay, now this is another day where you have a clumsy Asian session. This is not an ideal trading day, but let's see what happens. Price actually gave us the Asian session, which is 37 pips. Okay, that's still ideal, 37 pips. And then price traded above the Asian session and time distortion happened. It took some time above the Asian session high. We are looking for a breaking market structure to sell. Then look at what happened. Price broke structure after sweeping liquidity above that high. So it's a liquidity grab. And then what do you have here? This is a breaker block. Remember how I just explained the breaker. Price from the high, from the low, higher high, and broke structure. So the low of that other block is where you are going to be selling. Okay, price returned to it on this candle. Price traded into that, and then we sell. We sell, guys. We sell. We sell from that point. So price traded into that last sell candle, and then we sell. Stop loss is above this other block. So, and that's another 40 pips is bagged, guys. So this is the breaker. 40 pips is your target. 40 pips is your target, guys. 46 pips. You're done trading. You're done. So this is one of the days when you're going to miss it, because this, you may not be able to get this every single day. Remember, I said day trading is not everyday trading. There are a few days you're not going to get this right, so be comfortable with such days and move on. You don't have to catch this every single day to get it right. And most of the times you see price action like this, it's usually influenced by a high impact news or events like the FOMC, CPI, and their likes. This is why you see a clumsy day like this. Okay, guys, so let's keep this day, because even if you are taking a trade after price traded above the Asian session, did price break structure? Yes, it did. But if you had entered here, price went down, you would have been taken out on this. Okay, and I believe this is actually a retracement on the daily time frame, but let's not really talk about that now. So this is another day. Okay, price has been retracing actually into that daily institutional reference point, which is the other block we outlined. Okay, you can see it from a 15 minutes time frame. I'm already seeing it. This is the other block, and this is actually a breaker block. So price went into that internal range, pick up orders, and then continued bullish. So this is another day, Asian session. Measure the range first, look for price to trade above it or sell at the high. So if you study this carefully, price broke structure before the London Open, price broke structure within the Asian session. This is a breaking market structure, and this is mitigation block. We are looking to sell once price returns into that mitigation block. Where are we going to sell? We will sell when price returns to either an order block or fair value gap attached to the mitigation block. In this case, you have a fair value gap. So what you will do is just mark out the fair value gap and wait for price to return to that fair value gap. Okay, these are days when you may even miss an entry, because this happened even before the London Open. This actually happened. Be comfortable with days when you are going to miss entries too. There are days like that. Okay, so if you had entered a short at the low of that fair value, that's the rule. You execute a sell or buy at the high or low of the fair value. In this case, the low of the fair value gap, that's where we're executing our sell, stop loss above the high of that other block. What's the goal? 40 pips. We're done. This is day trading, guys. 40 pips. This is 49 pips. We're done. Allow all of this to run. You can take partials or take off all your positions or 70% of your positions and allow price to run. But most of the times, I would like to just take up profits and I'm done for the day. Okay, so this is another day again. So this is when price had traded into that daily institutional reference point, that other block, and we're about to start going bullish again. Then let's look at how we're going to take advantage of this. Okay, identify Asian session. This is the Asian session. Look for price to trade below or into the internal range when there is a breaking market structure during the Asian session. In this case, we had a breaking market structure during the Asian session. Price from the high, failure swing, price broke structure somewhere around here. When the body of the candle closed above it, we are looking to buy once price returns into the other block or mitigation block. This is actually mitigation block, but it has a confluence of fair value gap attached to it. So mark out the fair value gap straight up. This is the fair value gap, and I'll be looking to buy once price returns to the low of this, to the high of this other fair value gap. That's where I'll be looking to buy, and I'm only looking to take 40 pips on this trade. Once I take up 40 pips and done, I'd like to do something else with my time. Stop loss is below that other block. That's your SL. Okay, 40 pips on this trade. Let's see what 40 pips looks like. So you can see this is 64 pips. You must have been done long ago. Be comfortable allowing all of this to run. You don't need to catch all of this. I'm not teaching you to catch trades from the low of the day to the high of the day. That's not what I'm teaching you. I'm showing you an easy strategy to be able to catch something within the daily trading range, because that's what day trading is all about. Okay, catching something within the daily trading range. This is another day again, Asian session. Okay, we are looking to sell below or once price returns into internal range when there is a breaking market structure during the Asian session. So which of the criteria do we see here? This is an Asian session. Price broke structure during the Asian session. How do we know price broke structure? Price from the low, lower high. Price failed to form a lower low. Price broke structure. What you have here is a breaking market structure, and then price returned into internal range liquidity. Which of the internal range liquidity in this case? We have another block. It has a fair value gap. This is an old low. Price swept that old low, okay, to trade into a tiny fair value gap here. It's really very tiny. Okay, you can say that this is another shift of market structure. Let's just do this. Breaking market structure, I meant to say. Price broke structure, price returned to fair value and other block. You see that price returned to it. You're looking to catch 40 pips. 40 pips. And you're done. I don't have to measure this because this obviously looks more than 40 pips, 62 pips already. You are done. Allow the rest to run. Okay guys, allow the rest to run. This happened in London session 2, 8:15. This is London. This is another trading day, Asian session. Okay, you measure the Asia. Remember, ideal trading range is between 20 to 40 pips. So this is actually 31 pips. So the high to the low of the Asian session, 31 pips. It's ideal. So price traded below it. What are you going to do? Look for breaking market structure. So let's see where price broke structure. Price broke structure around here. Please, if you are struggling with how to identify breaks in market structure, kindly refer to one of the videos on this channel on market structure. Just go through the videos and then watch that video on market structure. You are going to learn how to identify structures the right way and how to identify breaking market structure. So we have a breaking market structure. Look for a return to internal range. Internal range. In this case, what do we have? We have a fair value gap, tiny fair value gap down there. That's where we are going to be entering. That's where we are going to be executing our buy, guys. Once price returns to the high of this fair value gap, we execute our buy. What are we trying to catch? 40 pips. 40 pips, 40 pips, 40 or 50 pips. That's all. Okay. This is actually a very good point to take profit above that high, which is the immediate external range. Liquidity residing above it. Let's see if we get 40 pips. 52 pips, guys. This is very good concept. So you see how powerful this concept truly works. Yeah. Now this is another time when there is a sell retracement on the daily. Okay. Another thing you should take notice, for every 3 candle price action you see in one direction, expect an opposing retracement. So for example, if I have 3 bullish candles on the daily time frame, the 4th candle I'll be anticipating a sell retracement. Okay, this is not a hack. It happens a lot of times. Okay, so when you go and study the daily time frames or higher time frames, you see that happening again and again. So guys, this is another day. You have Asian session. Price broke structure during the Asian session to the downside. I will be looking to sell once price returns to internal range. What's that internal range? When you look at this carefully, guys, carefully, what do you see? Fair value gap, another block here, the extreme fair value gap. And then some of you will be asking, why not this? Because there's an equal high here. So the institutions will run the liquidity residing above these relative equal highs. They are called buy-side liquidity, and this is a liquidity void. So look at what happened. Price traded above this relative equal high. Retail traders who are impatient must have been caught on this trade, because price traded into it and started going down. They must have been caught on this trade. Price swept all of them, traded into this. If you were patient enough, look at what happened. Price traded into that institutional reference point, fair value gap, and then that other block. Okay, so we will be executing a sell around that region. Sell, stop loss above the high. Okay, what's our target on this trade? 40 pips. So let's see if we get our 40 pips already during the London session. 42 pips. We are done. This is New York entry. This is actually a manipulation. You can see the wick traded into that our initial entry, but the body of the candle was actually below it. So you will have been done trading during the London session and you're out. Allow price to do what it wants to do. You're not interested, guys. This is another trading day. Price formed Asian session. Let's see how many pips we have. This is 30 pips, which is ideal. So price traded above the Asian session high to sweep the liquidity residing above it during the London session. Price traded above it. What are we waiting for? Breaking market structure, and we look to enter. And look at what happened. Price broke structure, but price didn't return to give us our entry. In days like this, just stay off. You don't have to really execute a sell. Okay, just stay off, because these are days when there are high impact news like the FOMC here or CPI. I think this is FOMC. Look at what happened. Price went above, boom, because we are actually bullish. This is just a retracement, so that they will accumulate sell contracts to go long. Okay, so in days like this, again another day, price broke structure during the Asian session. You can see that this is Asia. Price broke structure and even gave us the entry during the Asian session. We had nothing to catch in London because we want to be selling at the low or below the low. We have nothing to catch on this trade. Be comfortable with this like this when you are not going to get an entry and price is going to go so long. It's going to be very painful, but that's what trading is. Learn to stay off the chart sometimes. You don't have to be on every single trade. Stay off when there is no entry or when the criteria are not meeting up. Just stay off. This is another day Asian session. Price traded into the high of the Asian session, and then we see a breaking market structure here. Let me show you. After price traded into its price broke structure, mitigation block, and it has a fair value gap attached to it. Where is that fair value gap? This is it. This is it. Okay, we are looking to sell at the low of the fair value, stop loss above the other block, and let's see what we can get. Remember, we are in a buy bias. So if you took this trade, 40 pips this is 49 pips. You are done on this trade too. So you can see that you will be right more times than you're wrong. More times than you're wrong. So this is another day. This is the Asian session. Price broke structure during the Asian session. We are looking to enter where? On return to internal range liquidity. This is 7:15, which is the London session. So on return to internal range liquidity, we will be executing our own buy. So what's that internal range liquidity here? Fair value gap. You can see it. It's very obvious. So just mark the fair value gap. Those of you who are struggling to identify internal and external range liquidity, please refer to the video on this channel on liquidity concept, the one I taught recently on liquidity concept. You are going to learn how to identify internal and external range liquidity. So look at this. Price just tapped into that internal range, that fair value gap, and it went away. Boom, price went away. Okay, price went away. If you waited for price to get to the other block, you would have missed it. But because we already know about internal ranges and what that means, you will have been on this trade and you would have got at least that your 40 pip target. This is even 65, more than even 65. This is 78. But we just want to catch 40 pips consistently and we're done. We are done. 40 pips and we're done. We're done, guys. We're done. This is another day again. Asian session, price broke structure during Asia. Okay, returning to it, still broke structure again. Then during London, we want to see price return to internal range. Price didn't during, okay, this is another entry. 7:15, it's actually London session. So we are looking to enter on return to internal range, which is this fair value gap here. We will just mark the fair value gaps. Now, in cases where you have more than one fair value gaps, okay, I know some of you will be confused. Which of the fair value gaps should I use? Now, how to rule out this is in two ways. Either to use your Fibonacci and measure between the low to the high, wait for price to trade below 50% and you buy, or you do lower time frame confirmatory entries. What that means is that I will go down to the lower time frame as price trades into each of those regions. I'll just go down to the 5-minute or 1 minute time frame and look for break of market structure and return to order block or internal range, and then I'll buy from that lower time frame. Okay, that way your stop loss is going to be very minimal, very minute. Okay, and then it's a way of helping you reduce the noise. Now you know that, okay, this is the one that's going to hold because you see a break of market structure on the lower time frame. Okay, so as price trades into that fair value gap or internal range liquidity, I will just go to the 1 minute or 5 minutes and look for break of market structure, and then I buy from it. Okay, so if you bought here, if you just took this buy, stop loss is below the fair value of the internal range. Okay, 40 pips is your target. This is even 50 pips, guys. You're out. 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 This is another day. Asian session price traded above it during the London. Above it, price broke structure. The price broke structure? Yes, price break structure here. Break structure. We are looking to enter on return to internal range, right? Which one in this case? This is actually a breaker. We are looking to enter once price returns to the other block attached to the breaker or fair value gap. In this case, what we have is actually a fair value gap. So look at the fair value gap here. Price just tapped into it, and this is the breaker, and then price sold off. You will have gotten your 40 pips straight up on this trade, guys. 40 pips straight up on this trade. Okay, this is another breaker. Price gave us a higher low, higher high, price broke structure. You would have still taken an entry around here. This is for re-entry. Okay, you really have to pay attention to the charts, because most of the things happening, if you don't pay attention, you will not be able to see it another day. So guys, I will need you to go to your chart and really back test this yourself, because you will have to train your eyes to see these things yourself. Go to the chart. I've given you a gold mine, something you can use over and over again to cash out profits from the market, just using these three principles. Identify directional buyers of the higher time frame, identify your Asian session range, you sell above or at the high of Asia, you buy below the low of Asian session or at the low of Asian session. You know when you will buy at the low, when price breaks structure during Asia prior to London or New York session, and when price breaks structure during Asia prior to London or New York. We will also be selling once price returns to the internal range liquidity, the fair value gap, the order block, the breaker block that has a fair value gap or order block attached to it. Okay guys, so go to your chart and look at these things yourself. Remember, we are in December and we are expecting that there's going to be a decline in volatility in the market, because this is the end of the year effect and there are no much contracts already. Institutions are taking off profit and accumulating contracts for the new year. So guys, if you like what I'm doing, I would like you to click the like button, share this video, and don't forget, subscribe to this channel and turn up your notification bell. Until next time, I wish you good luck, good trading.